Before we continue, I want to help you understand the difference between the two different methods of accounting that are available in Wave. These different methods are called cash and accrual, and the difference between the two really depends on when you recognize your income and expenses. In other words, when do your income and expenses show up in your accounting? With cash basis accounting, income and expenses are recognized when cash changes hands. Income is recognized when you receive cash. Expenses are recognized when you pay cash, regardless of when the income is earned or the expenses are incurred. With accrual-based accounting, the income and expenses are recognized when you're obligated to make the expenses or when the sale is actually made, regardless of when cash changes hands. Now this may be a little confusing just from those definitions, so let's look at an example that will help us understand the difference between these two. So let's say that I have a customer that is interested in purchasing one of my widgets. So on December 15th, I sell him a widget for $100, but he doesn't have enough money to pay at the moment. So I tell him that he has 30 days to pay. So on January 15th, my customer repays me that $100 and the sale is complete. Now, if we were using cash basis accounting for this example, then I would recognize the income for this sale on January 15th because that's the time when the cash is actually received. However, if I were using accrual-based accounting, then I would have recognized the income on December 15th because that's when the sale is actually finalized. So you can see that depending on when a sale takes place, the difference between accrual and cash can make a big difference in how your income and expenses look on your reporting at the end of the year. In this case, if I were using the accrual method, income is recognized in December, even though I don't have cash. However, if it's cash basis, the income isn't recognized in the year I made the sale, it's actually recognized the following year when the cash is received. So what does all of this mean for your business? Well, up to this point, all we've learned about so far are cash basis transactions. All the transactions we've learned to create are all related to something that is happening in your bank account. And for most small businesses, that's fine. Many small businesses operate cash basis. And particularly if you have a business where you receive cash at the time of sale, like with a retail shop or a farmer's market or something like that, then cash basis accounting is probably just fine. However, if you have situations where you make a sale but intend to have the client pay you at a future date, you bill them and they'll pay you later, then you may want to look at accrual-based accounting because the accrual-based accounting separates the sale from the receipt of cash. And that allows you to understand when sales are made, how much has been repaid on them, and how much is still due. You want to know whether or not your customers are paying you so that you don't leave cash slipping out the door. So in this upcoming section, we're going to discuss in more detail the accrual transactions that are available in Wave, specifically invoices and bills. If you receive cash at the time of sale and you typically just let the bank bring in your expense transactions, then these next few sections might not be as valuable to you. However, if you are interested in doing accrual accounting, you have transactions that pay over time, then I encourage you to watch closely through these next videos and we'll introduce you to invoices and bills and how they can help you manage that type of business more successfully. Thank you for watching the Bootstrapper's Guide to Wave Accounting. If you found this video useful, I encourage you to click the like button below, subscribe to our YouTube channel, and share this video with other entrepreneurs. Doing so will help us to continue creating more videos like this one for you and other Wave users here on the Accounting Lab.